Hey everyone, welcome back to the Investing Iguana channel. I'm your host, Iggy, and today we've got a spicy topic to dive into. We're talking about Singapore's export numbers for August 2023, which have fallen a whopping 20% year on year. That's more than what forecasters predicted. So, is this cause for concern? Should you be rethinking your investment strategies? Let's break it down. Before we go any further, just a quick reminder, hit that like button if you find this video useful and don't forget to subscribe for more investment insights. Alright, let's get into it. First things first, for those who might not be super familiar with the world of exports and why they matter, let me break it down. Exports are goods and services that a country sells to other countries. They're a significant part of a nation's economy because they contribute to GDP, employment, and so on. So when exports fall, it generally implies that the demand for a country's products and services is reducing, which isn't a great sign. It's like if you were selling lemonade and suddenly nobody's buying, your lemonade stand economy would suffer. So, back to Singapore. It's a hub for tech, pharmaceuticals, and manufacturing. And let's not forget, it's a global financial center too. A 20% drop in exports is something to keep an eye on, especially when it surpasses the forecasts. Now, I can already hear some of you asking, Iggy, why did this happen? There's no single answer, but multiple factors play into this. Economic conditions globally are one factor. The world is still rebounding from the impacts of the pandemic. Markets are volatile, supply chains are still a mess in some sectors, and consumer behaviors are shifting. So, this decrease isn't necessarily a surprise, but it's more than what was estimated. Another element to consider is competition. With the rise of technology and globalization, there are more players on the field. Countries like Vietnam, Taiwan, and even parts of Africa are starting to emerge as competitive export markets. This puts additional pressure on Singapore. Now, should you be concerned? Well, it depends on your investment portfolio. If you're heavily invested in Singapore-based companies that rely a lot on exports, you might want to keep an eye on things. This doesn't mean you should panic sell, but perhaps look at diversifying your portfolio or even considering hedges against potential losses. It's also essential to note that a one-month decline in exports is not necessarily indicative of a long-term trend. Economies have their ups and downs, and it's the long-term outlook that truly matters. Some financial experts even consider such downturns as potential buying opportunities, especially if the fundamentals of a particular company or sector remain strong. And what's the government doing? Usually, in situations like this, you can expect some form of intervention. Whether it's tweaking trade policies or offering incentives to exporters, the state machinery usually has some levers to pull. Now, I'd be remiss if I didn't mention the potential ripple effect. The global economy is interconnected. What happens in Singapore could very well impact its trading partners and even affect global financial markets to some extent. So, while the focus is on Singapore, the implications are broader. To wrap it up, while the 20% year-on-year fall in Singapore's exports for August is certainly a headline-grabbing number, it's not necessarily time to hit the panic button just yet. Keep an eye on your investments, look for diversification opportunities, and always consider the long-term outlook. That's it for today's video, folks. If you found this discussion insightful, go ahead and smash that like button. And if you haven't subscribed yet, what are you waiting for? Join the Investing Iguana community and let's grow our financial knowledge together. I'm Iggy, signing off. Until next time, invest smart and take care.